All right, folks, part 4, chapter 7. Probably got a couple more after this. Next thing we're going to look at concealed liabilities and expenses. Now, what the folks are doing here, take a look. This is kind of interesting stuff. Okay. Liability and expense omissions, but more importantly, notice this one, capitalized expenses. So by capitalizing them, then they're going to depreciate them. Okay. And again, depreciation takes longer. So if you capitalize something that should be expensed, basically you're extending the cost out. Another one, warranty costs and liabilities. And I don't know how much you remember, but these are estimates. And people love to play around with estimates. Okay? So, a couple other interesting items there. By the way, notice what they say here. Easiest method, among the most difficult to uncover, okay? Because you have to get all of the information there, okay? And basically their whole thought is they could just conceal the fraud in future periods. So they're just gonna just keep kicking the can down the road, so to speak, until they get through it. Capitalized expenses, notice here, this is the one we mentioned before. So when you capitalize something, right, these are assets because they provide a benefit for more than one period. I'm sure you probably remember that, this guy right here, for more than one accounting period. Okay. But what happens here, by the way, WorldCom, they were famous for this. So notice it minimize income, expensing them, you minimize income for current year tax considerations, and you increase income in future periods. Okay. So by expensing these items, you definitely alter the makeup of your financial statements. Okay. Returns and allowances, again, remember, they're estimated. So they just estimate a lower amount, right? And again, remember, this is a contra sales account. You know, I'm not sure how much you guys, and again, sales, return, and allowances. Okay. So, you know, keep in mind, estimating that warranty expense, what could that do? Well, imagine an automobile manufacturer, right? Now, I'm sure, you know, they have a lot of historical data, but if you needed to hit numbers, you know, just changing that by a small percentage could wind up with a huge difference, okay? So here they're noticing, here are some different, a list of items here. Let's see what's interesting within these. Unusual increase in gross margins, okay, in excess of industry peers, okay? Now, you know, if they're consistent like that over time, it's a little bit different story, okay? Notice here, again, out of line with industry peers. Your allowances for sales and returns, again, same thing, okay? Reduction in the days number of purchase and accounts payable, okay? So all of these are little indicators that start to let you know there could be a bigger problem. Now, improper disclosure, I'm sure you guys remember. This is the notes to the financial statement, okay? And again, they could just leave it out. They could leave out subsequent events, and I don't know if you remember, but this was after the period, right? But before, this was after the period, but before financial statements go public, okay? And again, they're supposed to put all those related party transactions, management fraud. By the way, management fraud, this is a big thing. And any accounting changes, these are supposed to be in there too. So again, I don't know, you know, all of this should be detailed in the notes, okay? When you leave out liability omissions, here they're talking about disclosing loan covenants. And these are, notice here, agreements that the borrower has promised to keep the financing in place. So that's one of the things. By leaving liabilities out, right, you look stronger financially that you are. And then any contingent liabilities, you know, these are only liabilities if certain events happen in the future. But, you know, here, think lawsuits. And by the way, lawsuits, I'm sure you've probably seen, can be some pretty large amount of money. I mean, I've even seen accounting firms for hundreds of millions of dollars in lawsuits. Okay. Subsequent events, this I mentioned before. Events occurring or becoming known may have a significant, okay, should be disclosed. Notice they avoid disclosing court judgments. Note, this is interesting, public record search, and you can find some of this stuff. So again, subsequent events, this is, after, this is events occurring and they happen after the financial statement period, but before the statements are coming out. These are supposed to be disclosed. Okay, management fraud, lying to auditors, an illegal act. I would hope so. Okay. Notice here, fraud. Can you imagine this? Must disclose fraud committed by officers, executives, and others in a position of trust. Boy, let me tell you, that's got to be the kiss of death when it comes to talking about your company. Related party, self-dealing, arm's length transactions. I'm sure you probably need arm's length, meaning that they're both parties have an interest. Parties have interest, have their own interests, I guess I should say. Okay. In other words, they're, it's not a fake transaction. By the way, Tyco was big for this. Oh my God. Kozlowski, I think his name was. Used all kinds of money for stuff. Okay. With improper disclosures, normally this is very much a top-centered thing. So notice what they tell you. Domination of management by a single person or small group. Okay. Board of Controls and Audit Committee, they're no good. Okay. So this, they're not doing very good. Let's see what else. Rapid growth. Yeah, this could be. I can't explain that one. Rapid growth, unusual profitability. Could be. Significant. My favorite. Here we go. Especially close to the period end. I mentioned that before. They pose difficult substance over form questions, right? Substance over form questions. So that mean what substance over form basically means? What does this transaction actually mean? What's taking place here? And then you're wondering, well, why are they doing it this way? That's what they mean by that. Let's see here. Improper disclosures. Significant related party transactions that are not audited. This would be a good one because they should, if it's a related party, overly complex structure. Okay. Unusual legal entities. Okay. This means somebody's busy. Remember that SPEs, Enron. You start going, well, why do you need a special purpose entity? And normally the answer is to cheat. Attempts by management to justify marginal or inappropriate accounting on the basis of materiality. Okay, so again, they're trying to downplay something here. Inappropriately limiting access to people or information of an auditor. You're not allowed to do that. Okay, not allowed to do that. Now, improper asset valuation. Okay, notice misclassification of long-term assets as current assets. And basically they do that to make the company look like they have less long-term liabilities. Okay, so it could be inventory, could be accounts receivable, long-term assets, any kind of business combinations. And again, each one of these creates some sort of fraudulent look at the financials. So inventory valuation, you guys probably remember low over cost of market. They can manipulate the account, inflate the unit cost. Okay. Phantom inventory. I think there was one of the ones we looked at. Oh yeah, it was the Crazy Eddies. Crazy Eddies. They used to count the inventory in more than one. They count the inventory in a couple different stores, right? And by the way, just to let you know, please keep in mind that when you're doing auditing, you're not counting every single item. You're doing your spot checking. There's a certain amount you need to do, and so they're not going to check all inventory in every store every time. So you check it and then you extrapolate your answer. But again, you can see how easy this could be to do. All right, folks, that is part 4 from Chapter 7. We'll be back with another part in just a minute.